The Federal Reserve has finally cut interest rates, and that is a massive turning point for the stock market. Rate cuts ripple across every corner of the economy, from the big banks to credit card networks to tech giants and artificial intelligence leaders. In today's episode, I am going to break down the top stocks to watch right now and explain why lower interest rates could unlock the next big move for these companies. When interest rates come down, banks and credit card companies often see a unique mix of challenges and opportunities. Take JPMorgan Chase as the leading example. This is the largest bank in the United States with over $3.9 trillion in assets. In a high interest rate environment, banks have enjoyed strong net interest income because lending spreads were wider. But as rates come down, borrowing demand picks up. Consumers and businesses are more likely to take out loans, refinance debt, and invest capital when it becomes cheaper. That is where a bank like JP Morgan can shine because it has scale, diversified revenue streams, and leading market share across investment banking, commercial lending, and wealth management. Importantly, JP Morgan has continued to grow deposits even through tighter conditions, which positions it well to capture new loan demand as credit loosens. The bottom line for financial companies is this: while narrower spreads may impact some short-term bank margins, the overall demand growth from lending, spending, and economic expansion more than offsets it. That is why JP Morgan, Visa, and Mastercard are positioned as winners in a falling rate environment. We are already seeing the early signs of this, with financial stocks gaining ground. An interesting statistic is that during the second year of monetary policy easing cycles since 1990, United States financial stocks rose an average of more than 20%. Now let's look deeper at the credit card networks. Visa and Mastercard are not traditional lenders. They make money every time a transaction flows through their network. That means their revenue is far more tied to consumer spending than to the level of interest rates themselves. But here's where rate cuts matter. Lower borrowing costs free up consumer budgets. People feel more confident spending on travel, retail, and services. That spending expansion flows directly through Visa and Mastercard's networks. In fact, both companies reported double-digit growth in cross-border transaction volume this year, which is a strong indicator that travel demand remains robust. Add in the trend of digital payments continuing to replace cash globally, and you have structural tailwinds on top of the cyclical boost from rate cuts. The bottom line for financial companies is this: while narrower spreads may impact some short-term bank margins, the overall demand growth from lending, spending, and economic expansion more than offsets it. That is why JP Morgan, Visa, and Mastercard are positioned as winners in a falling rate environment. Next, let's talk about the hyperscalers, the massive tech platforms that dominate cloud computing and digital advertising. Rate cuts are especially important for these companies because they rely on both strong consumer spending and heavy capital investment in technology. Amazon is a prime example. On the consumer side, lower rates stimulate discretionary spending, which boosts e-commerce volumes. On the enterprise side, Amazon Web Services continues to drive profits as businesses increase cloud spending. Rate cuts lower financing costs for corporate customers, making it easier to invest in cloud migrations and digital transformation. Amazon also benefits directly from cheaper debt costs when funding logistics, infrastructure, and data centers. Google, through its parent Alphabet, sits in a similar position. Advertising revenue, which is the bulk of its business, grows when companies have stronger budgets and consumers are spending more freely. At the same time, Google Cloud continues to expand rapidly, and like Amazon, the lower cost of capital supports both customers and Google's own heavy investment in artificial intelligence infrastructure. Recently, Google announced new AI integrations across its Workspace suite and search products, aiming to monetize AI directly within its existing user base. Lower interest rates mean businesses are more willing to experiment with those tools. Meta platforms also stands out. Advertising is highly cyclical, and as borrowing becomes cheaper, small businesses and large enterprises alike increase marketing budgets. That is money that flows directly into Meta's platforms like Facebook, Instagram, and WhatsApp. Meta is also investing heavily into artificial intelligence for advertising efficiency and into its long-term vision of augmented and virtual reality. Rate cuts reduce pressure on capital costs, giving Meta more flexibility to fund these projects while still generating strong free cash flow. In short, for hyperscalers, lower interest rates accelerate both consumer demand and enterprise digital transformation. That combination provides a powerful runway for Amazon, Google, and Meta. Finally, let's cover the artificial intelligence leaders, the sector everyone is focused on right now. And now the question is if it is the right sector to focus on for the coming year. In my opinion, this is one of the clearest areas where rate cuts can have a dramatic impact. For the simple reason that artificial intelligence companies are often capital intensive. They require billions of dollars in upfront spending on chips, data centers, and research. Lower borrowing costs directly improve their ability to scale without crushing margins. Take Nvidia, the clear leader in AI hardware. Demand for GPUs continues to surge from cloud providers, enterprises, and even governments investing in AI capabilities. When financing costs drop, customers can accelerate orders for expensive infrastructure that directly supports Nvidia's revenue growth. Another beneficiary of the rate cuts will be AMD because of several reasons. Its MI300 series accelerators have been gaining traction as an alternative to Nvidia's GPUs. Lower capital costs mean hyperscalers and enterprises are more willing to diversify their supply. That boosts AMD's long-term growth path. And then there are the software-driven AI players, companies building applications and platforms that sit on top of the hardware. For example, Microsoft, through its Azure Cloud and OpenAI partnership, is integrating artificial intelligence across Office, Dynamics, and GitHub. Rate cuts allow both Microsoft and its customers to fund artificial intelligence adoption more easily. Similarly, enterprise-focused artificial intelligence firms benefit as businesses shift budget back into innovation rather than debt servicing. The common thread is this: artificial intelligence requires enormous upfront spending, but has the potential for exponential payoff. Rate cuts lower the barrier to entry, accelerate adoption, and provide more room for companies to scale aggressively. That makes AI stocks one of the most compelling groups to watch in the aftermath of this Fed pivot. The Federal Reserve cutting interest rates is not just a headline. It is a fundamental shift that impacts every corner of the stock market. And it's very important to understand what this means for the companies that you are investing in. For financial companies like JPMorgan, Visa, and Mastercard, lower rates stimulate borrowing and spending, fueling transaction growth and loan demand. For hyperscalers like Amazon, Google, and Meta, cheaper capital supports both consumer spending and enterprise technology adoption, driving growth in e-commerce, advertising, and cloud services. And for artificial intelligence stocks, lower financing costs open the floodgates for the heavy investments needed to build the next generation of technology. As investors, it is important to remember that rate cuts do not automatically guarantee higher stock prices in the short term. Markets can still be volatile and valuations matter. But when you zoom out and look at the business fundamentals, these groups of companies have clear tailwinds that could position them as leaders for the next phase of the market cycle. Then we also have the historical data, which proves that rate cuts are historically speaking very bullish for equities. So following basic statistics, it is logical to expect higher prices in the 12 months after a rate cut happens. This is what I am personally expecting as well. Thanks so much for watching today's episode. If you found this breakdown useful, make sure to hit that like button and subscribe for more data-driven investing insights. I would love to hear your thoughts in the comments. Which of these stocks do you think benefits most from rate cuts? Is it the banks, the hyperscalers, or the artificial intelligence leaders? Let me know down below. And as always, I will see you all in the next episode.